Sure.
So, Tom, thank you for having me address your membership and your audience. One correction: I was the youngest CFP in the history of the College of Financial Planning. I got my CFP back before it was offered in maybe any college curriculums, and got it through self-study when I was an analyst in a pension investment advisory department. So I got my CFP at a very young age, college age, and was working in a firm my father started in a fiduciary environment. So that was my indoctrination to the financial services business. I graduated from school, left that firm, moved to sunny Florida, went to go to work for a life insurance agency, and so my early experience was using benchmarking tools like Morningstar as due diligence and decision support for reviewing mutual funds inside pension and profit sharing plans, making product recommendations, using Morningstar to identify the high cost funds and low cost funds, and maybe make some recommendations, using Morningstar to identify the good performing funds, the less good performing funds, and maybe make some recommendations. So when I went to go work for a life insurance agency, given that experience, it did not make sense to me when I was told that due diligence or decision support for life insurance involved running some hypothetical projection for one life insurance product and comparing it to one or some small number of other products. That just never made sense to me. And so you fast forward to where we are today, the CFP, the update to the CFP practice standards brings to life insurance that same experience that I had early in my career, starting in a fiduciary environment, and then over the years applying what I learned in that fiduciary environment to life insurance decision support, life insurance product due diligence, and life insurance product policy recommendations. And I will tell you, in my experience, which is getting close to 30 years, if there was ever an asset on clients' balance sheets that would benefit from and is in desperate need for fiduciary-like advice or fiduciary-oriented advice or the advice from CFPs, it's got to be life insurance. It is by far the last, largest, most neglected asset on clients' balance sheets. Some people take issue with that characterization, but think about it. Almost nobody knows what they're actually being charged inside their life insurance policy. And if they do know, they don't know whether it's competitive or excessive. And almost nobody knows what they're actually getting in performance. They know what the hypothetical projection was, but they don't know what they're actually getting in performance and whether that's good performance or inferior performance. So by my view of the world, it is without question, if nobody knows what they're being charged and nobody knows what they're getting in performance, got to be the last, largest, most neglected asset on clients' balance sheet. And it shouldn't come as a surprise that if no one knows what they're being charged and no one knows what they're getting in performance, it's also the worst performing asset on clients' balance sheets, at least relative to their expectations. Performance that's been so bad that it's now being written about in the Wall Street Journal and Forbes about client expectations being woefully underperforming client expectations and carriers increasing costs and policies lapsing and just again, last largest, most neglected, and worst performing asset on clients' balance sheets. By my experience, however, what the CFP standards now provides is a new way to talk about life insurance. So a way to talk about life insurance, much the way I learned to talk about life insurance, having started in a fiduciary environment first. And as we know from literally centuries, a couple of centuries of clients' best interest practices, whenever fiduciary principles were applied to an asset type or a segment of the financial services market, the client benefited from the promise of higher returns, more reliable results, and businesses grew. There were many in RIA started on the heels of ERISA that are now gigantic businesses. And I think the need is just as large, just as important for life insurance advice. And I'm already seeing businesses being built around the prudent selection and proper management of life insurance as an asset. So let's talk about how the change to the CFP practice standards gives us this new way of talking about life insurance. If you're a CFP, you've already received a book that looks like what is currently on the screen. And so let's look at what that roadmap, what the CFP board defines as advice and how that advice is delivered to clients, and then we'll apply it to life insurance. After we do that, I'll also talk about how the CFP roadmap contrasts or differs with decision support or due diligence under the prevailing standard or the prevailing regulations, which was issued by the National Association of Insurance Commissioners, or the NAIC. At least they issued the model reg, and it's been adopted by most states. And then one state has actually changed the definition of clients' best interests for product recommendations, and we'll talk about that. And then we'll wrap it all up with the idea of using benchmarking technology for life insurance in the same way that I use benchmarking technology or Morningstar as a 19-year-old kid in a pension investment advisory department. So the roadmap says that financial advice is any communication that would reasonably be viewed as a recommendation or a product recommendation that the client take or refrain from taking with respect to the purchasing, holding, gifting, or selling of financial assets. So certainly, if a financial planner does a financial plan and there's some need for life insurance, and the part of the advice is a recommendation to buy a particularly type of life insurance, that would certainly be a recommendation that the client take with respect to purchasing a policy, or if the client already had life insurance, and a recommendation was for an exchange. Maybe the policy was underfunded, and so, or in the life insurance business, there seems to be this flavor of the day psychology to product recommendations, where universal life was the popular recommendation in the 1980s because illustrations looked good. Variable life was the popular recommendation in the 1990s because the illustrations looked good. Guaranteed universal life was the popular recommendation in the 2000s because everybody was once bitten and twice shy from the financial crisis and what happened to their VUL policies or UL policies. And today the popular recommendation is variable life. Is indexed life. And so if there was a recommendation to go from some other type of insurance to an indexed life insurance, that would be, again, financial advice, a recommendation that client take with respect to holding or not holding a financial asset or life insurance. The CFP board goes on. The roadmap goes on to discuss what financial advice constitutes for a CFP professional, and that is the CFP professional must act as a fiduciary and therefore act in the interests of the client at all times. So the elements of acting as a fiduciary, according to the roadmap, is a duty of loyalty, a duty of care, and a duty to follow client instructions. And I'm going to dive deeper into the duty of care under the roadmap, where a CFP professional must act with care, skill, prudence, and diligence. And I'm going to come back to that theme a number of times. That duty of care is consistent in just about every fiduciary standard or fiduciary orientation that I know of. Certainly that duty is in ERISA for the fiduciary treatment of assets in a qualified plan. It is certainly an element in the under the Uniform Prudent Investor Act, which applies to private trust, including life insurance trusts. It's part of the Code of Professional Conduct for CFPs, Code of Ethics for other professional financial services professionals. So again, I'll keep coming back to that advice that's in the client's best interests involves the careful, skillful, prudent, and diligent evaluation of certain things. And the roadmap goes on to say what those things are. It says that, and there's more than just this, but that the CFP must evaluate the costs that the client may incur. I know in my experience in talking with a good many CPAs, tax attorneys, trust officers, the costs are too often misconstrued to be synonymous with premiums. But there's actually a case, a lawsuit called Cochran v. Key Bank, where the policy didn't have any premiums, and it just stands to reason that just because there's no premiums doesn't mean that the insurance is free. It means that the costs are being deducted from the account. So the information that is part of any careful, skillful, diligent evaluation of the things that matter must include costs, just according to general fiduciary principles and certainly according to the roadmap. And the roadmap goes on to say that those costs can be found in the illustrations. But we'll talk a little bit about, we're going to talk a little bit more next about illustrations and whether or not the costs are included in the illustrations and how to get those costs. So I referenced before that the National Association of Insurance Commissioners Illustration Model Regulation, it has been kind of the law of the land, if you will, for product due diligence, for decision support for life insurance product recommendations. That NAIC Illustrations Model Regulation was issued on or about 1995 with a goal to ensure that illustrations do not mislead purchasers of insurance and make illustrations more understandable. So that was 30 years ago, 30 plus years ago. And when I give this presentation to a live audience, I always ask for a show of hands for how many people think that illustrations do not mislead purchasers of insurance and that illustrations have become more understandable over those 30 years. And nobody raises their hand. And in fact, the National Association of Insurance Commissioners in 2015 issued a update saying that we need to make some changes because for the past 30 years, we now know that the NAIC Illustrations Model Regulation resulted in a lack of uniform practice. In other words, the goal of the reg was to make it easier for consumers to compare the proposals or the illustrations from one product to the next, to make them apples to apples, in other words. And yet, by the NAIC's own admission, their illustrations model regulation resulted in a lack of uniform practice, where illustrations that looked to be the same were actually different. In addition to which, the NAIC illustrations model regulation does not require. So the CFP practice standards says, and fiduciary principles general say that costs are an essential consideration for clients' best interest. But the NAIC illustrations model regulation doesn't require any disclosure of costs or performance or risk for that matter. In fact, some years later, the FINRA, the chief regulatory body of the financial services industry, as I know most on this, probably everybody on this call knows, FINRA issued guidance saying that it is inappropriate, even though the goal of the NAIC was to make illustrations comparable, it is inappropriate to compare a life insurance policy against another one based on hypothetical performance. In fact, very much lines up with the CFP standards and fiduciary principles in general, that any comparison has got to consider costs and expenses. If you don't consider costs and expenses and investment objectives and performance and what have you, then such a comparison, it would be misleading. The Society of Actuaries, so the chief actuarial body of the life insurance industry, also commissioned a study. Again, this comparing illustrations thing has been vexing in the industry for a long time. And I will say, in the 1980s, when Universal Life first came out, and it gave the clients much more flexibility to design, and life insurance professionals for that matter, much more flexibility to design a policy with different premiums and varying premiums and what have you. Illustrations were the only thing around in the 1980s. But even so, just because it was the only thing, the Society of Actuaries said that comparing them to determine which product is better, while illustrations are useful for a lot of things, comparing them to determine which policy is better is just fundamentally inappropriate. And most recently, the OCC updated their handbook for unique and hard to value assets and cautioned, again, from a fiduciary perspective, cautioned the fiduciaries under their supervision that these illustrations are subject to a high degree of fluctuation, and anything that's subject to a high degree of fluctuation is not reliable for determining which product may or may not be in the client's best interest. We're going to talk about next some new regulations about clients' best interest, and that regulation, a New York regulation, was written about by Michael Kitces. He started with a white paper that I wrote for risk management and compliance professionals at big banks. And for those of you who read and follow Michael, you know that while I thought the piece was already a little long, Michael likes to dive deep into subjects. And so he actually broke it into two parts. And I don't remember, Tom, if this was part of the handouts, but if it wasn't, we can make it part of the handouts, and I'm happy to send it to anybody, and we've got my contact information at the end. But Michael wrote about how comparing and contrasting these illustrations under the NAIC illustration model regulation versus what are the common considerations essential to determining clients' best interest. So in this Michael Kitces article on page 5, you will see actual insurance company illustrations. These are not my, typing into a spreadsheet from an illustration. These are actual insurance company illustrations where it shows the hypothetical performance, and then it shows the pages that you've got to ask for. And we'll talk a little bit more about that, but they're commonly referred to as the detailed expense pages. So every illustration can include the cost, or actually most illustrations can include the cost pages. Most illustrations don't include the cost pages unless you ask for them, but most every illustration can include the cost pages, and you'll see examples of those very things in this Michael Kitch's article. Because it's impossible to read the article on the screen, I'm going to paraphrase here. Again, the NAIC Illustrations Model Regulation was intended to make illustrations comparable, that it's easy to understand which product is better, because we're going to write, the goal of the NAIC was to write rules that made the premium a proxy for costs, because the illustrations try to make everything apples to apples. And if everything is the same, if absolutely everything is the same, if the insured's age is the same, and the gender is the same, and the face amount is the same, and the health risk class is the same, and the tobacco use is the same, and the rate of the assumed rate of return on policy cash values, if everything's the same, then any difference in premiums would have to be due to differences in costs. That was the goal of the NAIC model regulation. So if we look at illustrations under a real life scenario using real life illustrations and using the premiums as a proxy for costs under the NAIC approach, we've got a indexed universal life product that is got a $13,000 premium and a universal life product that's got an $8,500 premium. And you might say, well, indexed universal life products have some reputation for higher costs, so that makes sense to me. So I think the universal life policy has lower costs, and I'm going to recommend the universal life policy because I believe it has lower costs. But let's wait a minute. Let's look at the actual costs. So if you look at the actual detailed expense pages shown in the Michael Kitch's article, you'll see that the indexed universal life policy has total costs over the expected life of the policy, total cost of $822,000. So the cost of the universal life policy has to be lower than $822,000, right? Whoa, wait a minute. The costs in the indexed universal life policy are actually higher than the costs in the costs in the universal life policy are actually higher than the costs in the indexed universal life policy, which is opposite to the exact opposite to what the using the premiums as a proxy for costs under the NAIC model regulation shows. The reason for that is because unless you dig deeper down into the detailed expense pages, what seems to be the case is actually not the case, which is why FINRA says that unless you're looking at cost and performance separately, it's misleading, which is why the Society of Actuaries said that comparing illustrations is fundamentally inappropriate, and which is why the OCC says that these illustrations are just subject to, or they're unreliable. So and again, this math is walked through in greater detail in this Kitch's article, but at one point in time, one of this universal life policy has $100,000 in cash value, and so we've told the producers, we told the people who generate the illustrations, the life insurance professionals, or the IMO or the BGA, we've told them to run the illustration at 5%. So you'd expect to see in the year where there's $100,000 of cash value, you'd expect to see $5,000 in interest. But there's actually $14,000 in interest and a 14.2, which correlates to a 14.2% rate of return, even though our instructions to the insurance professional or the insurance professional's instructions to the BGA or the IMO was that we wanted everything calculated at 5%. Well, if I'm going to calculate a premium at 14.2%, I'm going to beat a premium that's calculated at 5% every single time, because the inflated earnings, the earnings higher than what I asked for, and arguably higher than what is appropriate, those earnings are going to mask high cost, which is exactly what's happening here. But this problem is so endemic under the NAIC model regulation, in this illustration beauty contest, where everybody's trying to get the prettiest or the most attractive hypothetical policy values. Something like 70% of all index universal life policies, which is the number one selling product type nowadays, 70% of them are using a rate of return to calculate hypothetical values, to calculate premiums, that's actually higher than what you're being shown on the cover page of the illustration, or in the headers of all the hypothetical policy values. I believe this was a principal driver behind why the New York Department of Financial Services issued new clients' best interests rules for life insurance. Clearly, trying to use hypothetical premiums or illustrations under the NAIC regulation to support your advice is inconsistent with the CFP standards. The New York Department of Financial Services has issued some guidance for what they say is in the client's best interest for life insurance product recommendations. So let's see how that reconciles with the CFP standards. So the New York Best Interest Rule for life insurance redefines product recommendations, or redefines the decision support for product recommendations to consider the things that are consistent with other fiduciary rules. It starts with a focus on the consumer, and the first half of the best interest rule describes the things that you should know about your client, which all CFPs already know. It then brings in, just like the CFP standard, it brings in a requirement to exercise care, skill, prudence, and diligence in product recommendations. And if there are limitations in your ability to recommend a particular product, those limitations need to be prominently disclosed in writing. All of which, for those who have read the roadmap or the new CFP standards, very consistent with new CFP practice standards. It goes on to say that the product recommendations must be based on an evaluation of all products, services, and transactions available. So again, this is not flavor of the day product sales. This is, you find out, you do the fact finding about the client, and then you match up those goals and objectives and circumstances with the product that best fits those goals, objectives, and circumstances from all available products. Again, if there are limitations on that, then those limitations need to be disclosed. And the evaluation is not a comparison of hypothetical premiums, but an evaluation of, are costs justifiable? Is the performance reasonable? So going back to the example of in the Michael Kitchis article, if a CFP is requesting an illustration with hypothetical values calculated at 5%, 5% is a rate of return that's pretty consistent with a conservative investor temperament, probably maybe moderate conservative in today's low interest rate environment, but let's call it conservative. So if it's a conservative investor temperament, but the actual return required to meet client expectations is 14.2%, modern portfolio theory tells us that there's a correlation between risk and return. The higher return, the higher the risk. So again, the New York Best Interest Rule requires that the performance expectations be reasonable relative to appropriate risk. Again, very much lining up with the CFP practice standards. So the New York Best Interest Rule, again, lines up nicely with the new CFP practice standards, and it tells us what to do to advise clients on life insurance. So now I'd like to talk about, under the CFP practice standards, how you go about doing that. So I think I've probably already made the point that if it were me, and I advise several thousand life insurance trusts, the fiduciaries of life insurance trusts, and I still have my practice, I would not have a comparison of hypothetical illustrations in my trust file or in the trust file or in my client file. I just would not have that as my documentation for, or as my documentation for the decision support for a given product recommendation. I would never have hypothetical illustrations or a comparison of hypothetical illustrations in my trust file or my client file. At a minimum, ask for these detailed expense pages. In fact, go beyond asking. Insist on them. It is the CFP Practice Standards says you have to have that clients deserve to know what they're going to be charged. The premium is not what they're going to be charged. What they're going to be charged is what's deducted from the premium. So insist on these detailed expense pages. And again, you'll see examples of what they look like on pages 5 and 6 in part 1 of the Kitchus article that I mentioned, and that I'm happy to get anybody a copy of. And compare the costs in those detailed expense pages and the performance separately. And there's a discussion, again, in the Kitchus article, in part 2 of the Kitchus article. There's a discussion there about how you go about doing that. But, in every other segment of the financial services business, we still don't, kind of compare costs or compare performance of just one product to another or one product to 3 others. We benchmark. If went back in my days in the pension investment advisory business, we would measure the performance of a fund against the S&P 500, or we would justify the costs of a particular fund for a particular asset category against all other funds in that category and Morningstar. Benchmarking is established, commonplace, and proven in every other segment of the financial services business. So I see no reason why, and have built a business on the belief that benchmarking will be a faster, more effective, more reliable way of making life insurance product recommendations or doing the due diligence that arrives at a life insurance product recommendation and having the decision support in the files that supports that product recommendation in the client's best interest, as defined by client best interest practices in general and the CFP practice standards specifically. So there are a variety of benchmarking services. I mean, I mentioned the S&P 500. I mentioned Morningstar. There are a variety of benchmarking services for the different things that may be in a life insurance policy. I'll tell you that we benchmark the 5 things that are common to most decisions to either retain, exchange, or acquire a life insurance policy. We benchmark the financial strength and claims paying ability for a particular product against the universe of peer group alternatives. We measure internal policy costs. There are some benchmarking, quote unquote, I think it's a euphemism, quote unquote benchmarking systems out there that say that they're benchmarking, but they're comparing hypothetical premium calculations or hypothetical cash value calculations. So we're benchmarking actual costs. Premiums, as at least some, maybe many on this call have clients who have experienced that the premiums or the cash values never seem to come true, but costs do. Costs are on file with the State Department of Financial Service. Each state department of insurance. To change the cost, the insurance companies have to show justification for changing the costs, and then they got to file with 50 states and a couple of territories to actually change those costs. So costs, if there's anything stable inside a life insurance policy, it is what the insurance company says they're going to charge you. If they say they're going to charge that to you, chances are pretty good they're going to charge the client that or more. So we measure that which is reliable. We measure costs, benchmark costs. We also benchmark the stability of those pricing representations. Our client expectations based on actual mortality experience or some mortality improvement? Are they based on actual operating experience or some operating gains? Are they based on actual historical investment experience, or are they based on some hypothetical, like we saw in the Kitchis article, in the example from the Kitchis article? We benchmark cash value, the accessibility or restrictions on cash value, and we benchmark actual historical performance of invested assets underlying cash values, which over time is going to determine actual policy performance far more than whatever some hypothetical says at a point of sale or in an in-force illustration. So as I say, you can get some of this information from other benchmarking services. We have a number of patents. One of our patents is on the benchmarking of internal policy costs, and benchmarking internal policy costs versus comparing premiums tells you not just whether something appears to be better or not, or even comparing the costs of one versus another goes beyond just telling you which one may be better. It tells you relative to the entire universe of peer group alternatives where a particular policy is in terms of competitiveness of costs or excessiveness of costs, because with benchmarking, we know where the kind of the standard deviation is. We know that there's in most age cells, there's an 80% variance between good pricing and bad pricing. So once we know where the variance is, and once we know where the mean is, we know where worst available rates and terms are in the marketplace, and we know where best available rates and terms are in the entire marketplace. So by benchmarking, I said it's faster, easier, more reliable, more complete. With benchmarking, we know at a glance whether a particular policy is among best available rates and terms or involves excessive costs. And in this case, this is an excerpt from a real-life Veralytic report. In this case, this in-force policy has competitive costs, and so absent some other reason, maybe the client's risk profile has changed, but absent some other reason, regardless of what the illustrations may say, which in the Cochrane case I referenced, they made a number of exchanges that were really questionable based on illustrations, but had they actually measured the costs, they probably wouldn't have made those or benchmarked those costs. They probably wouldn't have made those exchange decisions and probably not gotten in litigation. Because at a glance, you can see that this policy is well priced. In addition, I don't care how good the illustration looks. Back to that Michael Kitchis article, the premium looked good in that universal life illustration, but the costs were high. And by benchmarking, you can see, again, at a glance, whether costs are average among best available rates and terms, or in this case, close to being among worst available rates and terms. In addition, benchmarking allows us, with really simple math, to understand the opportunity to help a client here. In this case, again, because having gone through the benchmarking example, we know that best available rates and terms should be about 10 cents per dollar of insurance. And I'm looking at the scale over here. This is the cost per $1 of death benefit here on the Y scale. This is the policy under evaluation. This is the benchmark for big face amount policies with $1 million face amount and higher. So we know here that if the best rates in the market are 10 cents and this client is being charged 17 cents, with simple math, we know, okay, the client's being overcharged by 7 cents per dollar of insurance. So for $1 million policy, with simple math, I can say, again, at a glance and in a matter of moments, I can say this client is being overcharged by $70,000 present value. I should be able to go find the client $70,000 if I either do a search or I engage a professional partner or a sub-advisor or an insurance professional who embraces this notion of benchmarking. They should be able to do a search for a product that finds $70,000 in savings, which can either be used to buy more death benefit, or if the policy is underfunded, it can be used to restore funding or reduce premiums or grow cash values more. Whatever the goal or objective of the client, if you find these cost savings, you bring them to the client, and the client determines, well, maybe I just want to take that $70,000 out and put it into my retirement plan. Whatever they want to do with it, with benchmarking, without running a single other illustration, you can have the conversation about finding them costs and what would they like to do with it, and then following through on the financial plan from there. The other thing that is commonly benchmarked everywhere else in the life insurance, in the financial services business, except for life insurance, is the rate of return that's reasonable to expect. There is much debate in the life insurance business about the rate of return that should be shown or can be shown in these illustrations, again, as shown in that real-life example in the Michael Kitchis article. Well, life insurance is not exempt from the principles of modern portfolio theory. So let's think about life insurance in the context of modern portfolio theory. Study after study confirms that the greatest driver of long-term performance, at least in terms of the rate of return, is the risk tolerance of the client, the asset allocation corresponding to that risk tolerance, the time horizon over which we can withstand or absorb or wait out volatility, and the expected outcome. Again, using benchmarking, like an asset class benchmark, for what would be reasonable to expect out of a particular policy or out of a particular asset allocation, and so then let's look at that, at how those asset allocations match up to the different product types. So, for instance, a client with a conservative investor temperament, they would the asset allocation appropriate for a conservative risk profile would be, maybe 20% equities, 80% fixed income. Well, whole life policies and universal life policies are required by regulation to invest in high-grade bonds and government-backed mortgages. So a universal life, most forms of universal life, except one I'll come back to in just a second, and whole life, since their cash values are required by regulation to be invested in conservative assets, that is certainly a product type that is good for a conservative investor or a conservative risk profile. Irrespective of what the illustration may say, indexed universal life is still a universal life product. So, and this is often not well understood. Indexed universal life policies are also required to invest cash values predominantly in high-grade bonds and government-backed mortgages by regulation. The indexed universal life policies are defined or distinguished from other universal life policies in that the interest, and only the interest off of those bonds and mortgages, can be allocated to purchase options on an index. But because the policy is required by regulation to be invested in high-grade bonds and government-backed mortgages, your rate of return is going to be driven largely by the interest on those bonds and mortgages, and then with some lift, if the options exercise in the money, some lift off of the historical return for high-grade bonds and government-backed mortgages. And then from moving further out in or more aggressive across the risk profiles, the only policy that's really that according to taking a modern portfolio theory perspective, the only policy type that really allows for the allocation of assets of underlying subaccounts into the asset classes that would generate the higher returns would be variable universal life. Again, according to modern portfolio theory, irrespective to what the illustration says. But we saw in the Michael Kitchis article that the rate of return on the illustration may or may not actually be the rate of return required to meet client expectations. So another thing that we do inside the Veralytic report is we show both the rate of return that is declared on the illustration, the rate of return prominently displayed atop all the hypothetical policy values that are presumably calculated at that rate of return. But then the Veralytic report also calculates the undisclosed or underdisclosed bonus credits, bonus interest credits, and the actual rate of return, so that planners can make that risk assessment. That, you know, if I've got a client who's got a moderate conservative risk profile and a 6% rate of return might be appropriate, but the product actually requires an almost 11% rate of return, that's really more of an aggressive risk profile. And so by benchmarking costs separate from performance, both in understanding the rate of return required in the illustration to meet client expectations, and then relating it to asset class benchmarks, you can get a sense for the risk inherent in any life insurance product recommendation. So I think I've beaten this horse enough. Benchmarking cost separate performance is common in every other segment of the financial service business, consistent with the best interest rules and required under the CFP practice standards. And Veralytic is FINRA reviewed, so it follows that FINRA rule that I referred to before. And if I'm a CFP, I just wouldn't have illustration comparisons. If I'm a CFP, or frankly, if I'm any financial advisor with a duty to exercise reasonable care, skill, prudence, and diligence, or I'm serving any advisor, any CPA, tax attorney, or trust officer who has a duty to exercise reasonable care, skill, and prudence and diligence, I wouldn't be using illustration comparisons anymore. Instead, certainly benchmarking is common everywhere else. If you'd like to see how benchmarking would work for life insurance, how Veralytic would provide you benchmarking information for life insurance, I always offer a complimentary report at the end of any webinar, so you can see for yourself that benchmarking is certainly easier and faster than trying to figure out and compare illustrations. It's certainly more complete because it's measuring against the universe versus just comparing, a couple, one against another or a couple against another. It's more reliable according to FINRA. It's compliant with CFP practice standards. So Google, all you need to do to get a complimentary Veralytic report is if you can see that URL, that web page address, you can write it down, or you can simply Google complimentary Veralytic report, and it should pop up. If it doesn't pop up, then you are welcome to email me. Email address is on the screen. If you don't have a policy on your desk, and by the way, the complimentary Veralytic report is for a policy of your choosing. It goes beyond a sample report, which looks good, but doesn't have any meaning because there's no context, or doesn't have any specific meaning to the planner because there's no context. So the complimentary report is for a policy of your choosing. If you want one and you didn't catch that web address and the Google idea, Googling complimentary Veralytic report doesn't work, email me. If you don't have a policy on your desk right now, then I speak about this, frequently post articles about clients' best interest in life insurance on LinkedIn, less so, but similarly on Twitter. In fact, my Twitter following is much smaller than my LinkedIn following. So if you want to just help me build my Twitter following beyond my 2 kids and mother-in-law, then follow me on Twitter. Or again, feel free to email me. In the meantime, thank you all for your attention here. I see that just about everybody who was on the call at the beginning stayed, so I thank you for your attention. Tom, thank you, and the Financial Experts Network for having me provide this webinar today. And with that, I turn it back over to Tom.
Great. Thank you, Barry. And as always, we have questions coming in. And as a reminder, feel free to keep posting questions. And Barry has plenty of time to take questions. And apologies, I realized after the fact I saw the post that I had not shared my screen. We were going back and forth, and sort of a quirk of go to webinar is you have to constantly click on the share my screen button. So I apologize, but for those interested that are guests, if you're interested in signing up for the program, I just wanted to show this URL. You can go to the website financialexpertsnetwork.com, add the /CE, and that would help you purchase, if you like, a credit for today. And again, you would then have the ability to partake of the webinars coming up as early as tomorrow with Larry on investment concepts to think about in rough times, college financing Friday, ethics CE March 19th, and much more to come. So let me do this before we take questions. And again, you're welcome to keep posting questions. I'd like to, and one of the things, Barry, I'll put you on the spot. I'd love to have you back. And we talked about doing a lot of different sessions, but I actually think, I think to have you back to do perhaps a couple case studies all around life insurance planning, and let's have Veralytic use, if you're open to this, as sort of the engine to drive some case studies. Would that be something you would be interested and willing to do?
I'd be happy to do that. Can I answer my own? Can I answer? I mean, there's a conflict of interest here in me answering this survey question. Am I allowed to answer it?
You can if you like, sure. Yeah. So what I'd like to do is, again, for everybody out there, if you're not a member already, we do have case studies on a regular basis that are sort of a second webinar track, roughly about 30 minutes in length, totally focused on client scenarios where we might have a range of different situations and client challenges or problems, and that would cut across from college financing to the first one we did was on 1031 real estate exchanges. Had a CPA who has a wealth of experience on that lead that session. So my goal there is to really have it all about case studies. So again, would love to have you back, Barry, for just a session where we go through perhaps 2-3 different client case scenarios and really just show how your tools could help with that. So,
what would be great, if I can interject, sure. What would be great in that regard is for one or more, actually two or more of the listeners to take advantage of the complimentary Veralytic report, so that we could talk about them as a case study, and we can use their fact pattern, and they could talk a little bit about what the circumstances were, client circumstances were, goals and objectives.
Sure.
And then how we used Veralytic to support them, to give them the decision report for whatever the recommendation, retain or exchange or whatever, that's consistent with CFP practice standards. That'd be fun.
Yeah, that's great. So all the members listening out there, you have an opportunity. So please take advantage of that, and happy to have whatever you put together. I can certainly get that to Barry. And by the way, I will post the Kitsitz report on the replay page under helpful resources. So just to put that out there. So again, for all the members, we'll post the replay along with Barry. I'll just count on you to forward that to me at your convenience.
I sure will. Sorry I didn't do that before.
No worries. I'll put that on the replay page. Okay, let's fire through some questions. And again, for anyone that needs to jump off, let me just mark the time, 12:03 Eastern. You certainly have satisfied the CE. I hope you stay on and listen to the questions, though I think you'll find great value there. Okay, a lot of questions from Bruce. Bruce, good to see you on. What decade was the whole life most popular? That's from Bruce, Barry.
So prior to the introduction of of universal life in the mid '80s, or at least the introduction probably predated that, but the popularity in the mid '80s, there were two product types. It was whole life and term. So term, just is a was and remains kind of a I shouldn't say niche product, but I mean it's for a specific need. It's for a specific term, versus the more varied uses of permanent insurance. So whole life was the flavor of the day, if you will, prior to the mid '80s. And interestingly, for some reasons I can get into if we want. Interestingly, whole life has kind of come back now as a close second to flavor of the day, close second to indexed life, as the current flavor of the day.
Okay, interesting. Yeah, things come in cycles, I guess. Next, how should the cost be calculated and compared at varying time intervals and/or at the client's life expectancy, or something other than this? Again, from Bruce Barry.
So I invented Veralytic, having had the Morningstar experience first, and then working in this agency where they said comparing illustrations was the way you did due diligence or decision support for product recommendations, and that just didn't make any sense to me. So the invention of Veralytic was to provide a way that was more consistent with fiduciary principles, fiduciary orientation, the client's best interest. But Veralytic includes some judgmental techniques that are my techniques. They're fully disclosed in the user guide. They've been reviewed by FINRA, but they are my techniques. So I'll answer it from how Veralytic would do it, and I qualified it that way to say that I'm not saying just because Veralytic does it that way that that's the only way to do it or the only right way to do it. Veralytic calculates costs over the entire expected holding period. If the expected holding period is age 120, then it calculates costs on a present value basis for all the way from age 120 back. If it's to age 100, then it's age 100 back. If the client has some impairments and the client sees no reason to fund the policy to age 100, then it's whatever the illustration says, or whatever the coverage duration of the illustration that's submitted says. And inherent or implicit in the use of present value is whatever that cost is at age 120, whether it's 50 years from now or 100 years from now, or at age 100, whether that's 30 years from now or 20 years from now, whatever. Obviously, that charge 20 years from now is discounted for the rate of return at which premiums or cash values would otherwise be credited in the illustration. So it's not a sum of all costs, which would I think skew the results, because you don't know when the client's going to die, and so you don't want to put too much emphasis on the cost in the out years, but you don't know when the client's going to live till, so you need to put some emphasis on the out years. So it's the present value of all costs over the expected coverage duration. That's the way Veralytic does it.
Yeah, that logic makes a lot of sense to me. That's my 2 cents. Next from Brad Barry, what would you use as an investment performance benchmark for an equity index universal life policy?
So I have that's probably the hardest question that I get asked. Yeah, who asked that one?
Brad. Kudos, Brad.
Kudos, Brad. That is. So let me tell you what I don't think it is. The big debate amongst the National Association of Insurance Commissioners right now, actually, your question is the big debate amongst the committees of the NAIC wrestling with this issue, and it's taken them since 2000. So they've been working on this for 4 years. They still don't have an answer. Their first answer, I think, is wrong. Their first answer is that the rate of return, and this is not directly answering your question, but I'll get to it. Their first ruling on the rate of return that's allowable in index universal life illustrations assumes that 50% of all options, 50% of all options are exercised in the money. I've not found any basis for that. If there's anybody on the call who has any research on the profitability ratios of options trading, I would surely appreciate it. I've always thought of options trading to being a relatively high risk, so you get high return, but you get low frequency of those returns, which is kind of inherent in a high risk instrument. I've always thought of options as being a high risk, and I mean, and the SEC considers it a separate risk category, because you've got to get a separate license for options if you are only Series 6 licensed, right? Of course, you don't for index life, which is a whole nother conversation. Because the cash values are invested in high-grade bonds and government-backed mortgages, which influences the rate of return, and only the interest off of those bonds and mortgages is used to buy the options, there is no benchmark. Now, having said that, one of the members of my team that I'm privileged to have is a master's in math from the University of Illinois, and she came up with a way to amalgamate long-term historical performance for fixed income instruments, and then provides a calculation for some lift, some standard deviation or some lift for the equity piece. That's how it's measured in the Veralytic report. That measurement is not shown graphically as a benchmark, but it shows up in we measure those 5 things. We assign a star for each of the 5 things, so it shows up in star number 3, the stability of client or the stability of the illustrated expectations. And I wish I had a better answer for you, but because it's such a good question, because the NAIC can't even seem to answer it, that's the best answer I got.
Very good. Next from Richard. Richard had to leave, but I think it's certainly really a great question. And that is, Barry, would it be safer for any planner, for that matter, and their client to simply use a plain vanilla whole life contract from a top carrier, say like New York Life or Mass Mutual? This is, of course, this assumes, of course, that permanent protection is desired. That's a good question.
It is a good question. In fact, so that's actually as good a question as Brad's, for an entirely different reason. It has to do with a market conduct or a market perception reason, more than a deep analytic reason. So there's, for every product, for every single whole life product, and if an insurance company offers more than one whole life insurance product, then they have, for the second life insurance product, every single one of them has more than 10,000 different prices. If you think about it, there's a different price for every age,
sure,
times 2 for gender, times maybe 3 for non-tobacco use, tobacco use, and in some cases never tobacco use, times 5 for standard, standard plus, preferred, preferred plus, double backflip, decathlon preferred, times 4 or more for the different banding, face amount bandings, which in the mutual fund business we'd call volume breakpoints, times at least 3 more for the different funding strategies, single pay, limited pay, level lifetime pay. So there's 10,000 different prices for every single product. No insurance company is good at all of them. No insurance company is bad at all of them. It depends on the cell, on the cell that corresponds to age, gender, risk class, etc. If you are just looking at a whole life product and saying, well, whole life is kind of my default because it's been around since the 70s, it's tried and true, da da da. I don't think that comports with the new CFP practice standards, because you got to look at the costs. It's clear in the roadmap. You got to look at the costs. So some whole life products are going to have high costs. Some whole life products are going to have low costs. If it's a whole life product that has low costs and the client has a conservative investor temperament, then I think whole life makes perfect sense. But as is evident by my answer, I don't think it makes sense all the time.
Mm-hmm. Yeah, interesting. So, folks that are still listening, if you could do me a favor, let me know what interest you have in the case study idea I've suggested with Barry. Barry seems open to doing it. And again, I'm reminded of this. If you want to just post in the question panel, would you come to a case study session like that? Because I have a question from Paul. Again, Paul had to leave, but I think this is interesting, Barry. How do you address the current cost of insurance versus the guaranteed cost of insurance in your benchmarking process? For example, do you look at historical data or only what's presented on the illustrated cost pages of the ledger? This, to me, seems to be something that we can go into in much greater detail when we have you back, but certainly welcome your comments on this as well.
Sure. So there is two types of guarantees in two different product types. There are guarantees in guaranteed universal life. Those guarantees are designed for the consumer. They are guarantees that the insurance company makes for a premium that would be competitive in the marketplace. So if you were to compare a guaranteed universal life, if you were to compare the premiums for a guaranteed universal life policy to the premiums for a universal life policy or a variable life policy or an index policy, those premiums would be comparable because the guarantees are designed for the consumer. They're designed for the client. On the other hand, all products have guarantees. Whole life products have guarantees. Universal life products have guarantees. Even variable life products have guarantees, no investment guarantees, but even sometimes investment guarantees. So all products have guarantees. The guarantees in all products except guaranteed universal life, sometimes referred to as universal life with secondary death benefit guarantees. The guarantees in all other products are not designed for the consumer. They're actually designed to establish the reserve requirements for the carrier. Just like a bank, an insurance company makes their money on leverage. A bank, takes in a bunch of deposits, but then they loan out 10 times that amount of money, and they make interest on the spread. Same idea. The insurance company takes in premiums, but they know, not everybody's going to die today. They know that they're going to have to pay money out, just like they're going to, same analogy to the loans. They're going to have to pay money out at certain points in time in the future. So they write a lot more insurance than they take in premiums. The amount of insurance that they can write is governed by the guarantees in these products other than guaranteed universal life. And so the guarantees in like two whole life products, the guarantees will be very, very similar because they're based on statutory reserve requirements in both cases. So our view is that the guarantees that are designed in products for regulatory reasons and that are largely homogeneous across different products aren't really part of a decision-making process. because they really don't. I mean, they rarely, if ever, come into play in actuality, let alone during the decision-making process. What does come into play is what is the carrier currently charging? And is it stable? Now, some will say, well, they can change it. Yeah, I know, but we make mutual fund decisions like that all the time. The mutual fund company doesn't guarantee their fund management expense is going to stay the same forever, but if they have a low fund management expense and they have a track record of not increasing that fund management expense, those are important elements of the decision-making process. Likewise, if a carrier has low cost of insurance charges, which are the largest expense in any life insurance policy, if they have low cost of insurance charges and they've calculated their cost based on actual mortality experience, not some mortality improvement, and they have a track record of not increasing their cost of insurance charges, then I think that's a much more relevant decision point than the statutory maximum guarantees built into all products except for guaranteed universal life.
Great. Next question from Ray, and again to do a time check, we have 12:19 Eastern, so about 10 more minutes of questions. We'll get through as many as we can, and again, we'll post the replay, and I'll also make sure we get a copy of the transcript out for, again, the members section as well. Good question from Ray, and that is, Barry, essentially, I don't think you've really touched on term. You just did briefly there, but given the fiduciary requirements that anyone with the CFP designation, of course, assumes, would the discussion of life insurance be, and recognizing that you have to do so in whatever it is you present, discuss, has to always have the best interest of the client in mind, would you be able to meet that standard if you are not introducing the idea of term life insurance?
So the first part of the New York Best Interest Rule talks about the things you need to ask the client in order to determine what product type and what product is in the client's best interest. And one of those things is, the duration of the need. They don't use those words, but the duration of the need. I'll tell you that if somebody has a temporary need, as a general rule, a temporary need for insurance, in other words, a risk management need, if their need is temporary, I want to make sure that I need time to fund my kid's college education. If I don't have time, I need I need insurance to replace my earning ability. I need time to pay off my mortgage. I need time to accumulate my retirement. If if the amount of time that you're trying to buy is limited in duration, then term insurance is almost always, more client's best interest than permanent insurance, with one exception, and I'll come back to that after I explain why. When an insurance company prices for term insurance, they will only write the term insurance up to what they consider to be life expectancy. So if somebody is, and I'm going to use round numbers here, this is not accurate, but if somebody's 50 years old, the maximum amount of term insurance you can get is 30-year term, 30-year level term. If they're 60 years old, you can't get 30-year term anymore. You can only get 20-year term. And the reason for that is because term, by definition, is intended to pay out before life expectancy. Well, that means that the insurance company, if they're only paying out claims that occur before life expectancy, since life expectancy is by definition that point in time when only half of the insured population has passed, the insurance company by definition is only paying out half the claims at most. If they're only paying out half the claims at most, they're only collecting half the costs, or half the premiums, or half the costs at most. So term insurance for a temporary need less than life expectancy, term insurance will always be less expensive. It will always offer lower costs and therefore be in client's best interest. The two exceptions to that are things, risks that extend beyond life expectancy. So If you're in a company that has a buy-sell agreement and you're going to buy out whenever the other partner passes, whenever that may be, even if it's at age 90 or 100, then that's a permanent need. And they're permanent insurance, because term insurance is always, for the reasons I explained, less costly up to life expectancy, but then it's always more costly after life expectancy. So permanent insurance would be better for a permanent need like financing estate taxes. The one exception is that life insurance does enjoy some tax preferences, and some people, and there can be a benefit to using life insurance for accumulation purposes for tax preferences, but only for people who have a more aggressive, not necessarily aggressive, but more aggressive risk profile, because the higher the rate of return, the more the benefit of the tax-deferred accumulation, the tax-deferred of compounding of cash values. So if you have a longer-term time horizon and a higher rate of return, then permanent life insurance can, you got to do the math on it, can also provide a tax advantage on the accumulations, where the cost friction in the product would be less than the tax friction or the tax benefits, tax savings on the accumulation.
Great. And again, we have a bunch of additional questions here. I just want to get to a few Veralytic related questions, and I'll try to group these together, Barry. One is the cost. We've had a few questions about the cost. Perhaps if you want to just describe, is this a subscription service,
yes,
or is it a pay? Okay, great. Do you want to just outline that, and then let me just bear with me 1 second. Let me just add another question. Can you do analytics on policies designed to create cash for income later from Oscar? So go ahead, Barry. If you want to tell us a little bit about your pricing and what you get for that, that would be great.
We have a number of different pricing, subscription, license options, but for most people on this call, it's going to be $199 a month, unlimited use. If you're not licensed, if you only need Veralytic for in-force policies, like you're an RIA, and you're not insurance licensed or won't, you just want the analysis of the in-force policy, you don't want to advise on the placement of a new policy, then it's as little as $99 a month, unlimited use for in-force policies. If you're part of a large enterprise, those are all customized. And call me. And yes, Veralytic is usable on policies designed for accumulation, but because different companies and different products calculate distributions differently, the illustration to be submitted for the report must include the detailed expense pages, but can't reflect the distributions. That would be a separate illustration that you would use with a client. The one you would send to us would not show those distributions.
So great, thank you for that. And again, lots of folks already posting. They certainly are very interested in the case study sessions. By the way, I'll just share that, again, one of the things Barry and I were talking about is I have a CPA that's also interested in being part of the case study and presenting ideas or strategies that really tie to the Secure Act and the now what, given the end of the stretch IRA. So looking to perhaps add that alongside Barry's case studies as well. But Michael makes a comment that Reg 187 requires affordability as part of the product selection. Barry, do you care to comment on that?
Other than not really, other than to say that I agree with that wholeheartedly. Totally agree. I mean, okay. It's consistent with, well, I guess it goes beyond the duty to incur, the general duty under fiduciary principles to incur only those costs that are reasonable and appropriate. So I would think affordability falls into the reason, or at least the appropriate part of reasonable and appropriate. So yes, it does. I totally agree with it, and glad to see I'm now one of two people who have actually read Reg 187 cover to cover.
Yeah, great. Question from Brad again, and was asking about the credit rate of 5.5, 5 to 6%. Excuse me. Actually, posing the question, Barry, do you think that's really reasonable to suggest that that credit rate to a client for WL and UL interest credit rates, again in the 5 to 6%? Do you think that's appropriate?
So those are my kind of my rule of thumb. There is, I mean, if you go back to 1926 and include the interest rate bubble and the current low interest rate environment, they're not out of bounds. But, you know, we are in a low interest rate environment a lot longer than I ever expected to be. And, you know, is this a systemic low interest rate environment? Are we never going to see high interest rates again? I don't know. So my crystal ball is broken. I do think 5 to 6% is consistent with historical performance going all the way back to 1920 something. But I don't know if we're, you know, in the 1980s, everybody was saying that the high interest rates were a new normal. I don't know if this is a new normal or not, but it is generally consistent with historical returns for high grade bonds and government-backed mortgages.
Yeah, absolutely. Again, Bill, I think we addressed, good to see you on, and thanks for signing up as a member this morning. Bill asked a question, how are the requirements different for the sale/purchase of term life insurance? I think you sort of addressed that, Barry. Really, how I took your comments was it really begins with suitability, understanding the client's needs, as it does with any financial product. I think you would agree.
Correct.
But yeah, okay, great. Again, you can add to that. But Bill, let me know if that answers. Good question from Nate. I'm going to sort of summarize this long question, Barry. He's with a major PNC firm, but is asking, what is the future for a Series 7 rep with a broker-dealer who wants to be a fiduciary, especially with the life insurance business? Any care to opine on that, Barry?
I think so. I came into the financial services business in the mid 80s, and the mutual fund business back then looked a lot like the life insurance business of today. Only about half of the funds available in the market were in Morningstar. There were things called investment contracts that paid 50% commissions on deposits. Certain types of investments were sold based on hypothetical projections, most notably tax shelters, you may remember. And ERISA and best interest practices around investments have transformed the investment business from looking a lot like life insurance of today into what it is now, which is, you know, open architecture, lower fees, more transparency, more focus on clients' best interests. I think that same transformation is underway in the life insurance business, and we're certainly endeavoring to do our part to contribute to that future where we bring transparency. We help people understand. I mean, if you think about what happened over the last 40 or 50 years in the 40 years in the investment business, Vanguard came on board, dimensional funds, or Vanguard came into being, and dimensional funds came into being. All of these, BlackRock came into being, where there was this migration of trillions of dollars of assets moving from high-cost funds to low-cost funds, and advisors getting paid all along the way, maybe differently along the way, but getting paid all the way, and growing their businesses with increasing assets under management. I think that same thing is the future of the life insurance business, where no one knows what they're being charged inside their policies. No one knows what they're actually getting in performance. If there was ever an asset that needed fiduciary advice or fiduciary-oriented advice or CFPs to help it with the decision making, It's life insurance right now. And it's going to look more and more and more over the next 30, 40 years. It's going to look more and more and more like the investment business today, with lower fees, greater transparency, more decision support tools, and more orientation toward clients' best interest. Not sure I answered your question. If I didn't answer your question specifically because you mentioned licensing, feel free to email me. But that's my general vision for the future of this business.
Just to follow on, again, we have a few more questions, and I'll stay on, Barry, for as long as you. It's 12:34 Eastern. If you're okay staying on 10 more minutes, and folks, if you need to jump off, by all means. But if Barry, do you have 10 more minutes, or do you need
Sure.
to jump? Okay,
no, I'm good.
Great. Let's rapid fire through. Sort of to follow on. David just left. I was going to take his question. So let me start with that. Are there any general agents or FMOs which will automatically provide your program, Veralytic, to their agents? Good question.
That is a good question. And yes, there is. I don't want to play any favorites here in public. So if you email me and tell me where you are, and maybe let's have a brief conversation, then I'd be happy to match you up with the right one.
And I won't put you on the spot, but perhaps we talk about offline. For my members, I don't know if you'd consider a favored nation pricing, but perhaps we can talk about that as well.
Sure.
Great. Michael had, and I think to follow on to your comments, Michael has a comment / question on, he's yet to see a breakout of costs with a whole life illustration. I think to your commentary there, I don't know if you want to add to that.
Yeah. So while these detailed expense pages are generally available for all forms of universal life, sometimes not as easily for guaranteed universal life, but most forms of universal life, they are generally available. Was that Michael who asked that question?
Yes. Yep.
Yeah, Michael's correct that they are not generally available for whole life illustrations. To get the detailed expense pages, you would actually have to convince, and this has happened. I've seen this happen on larger transactions where the insurance professional asks the carrier to have an actuary calculate the year-by-year costs that are routinely found inside universal life illustrations. But that's the only way to get it that's the only way to get it for whole life, unless you are a Veralytic subscriber. And Veralytic does it by using the same algorithms we use in the benchmarking process to essentially extract the costs. Because there's no disclosure of the discrete elements of pricing, we cannot delineate the differences between cost of insurance charges and maybe premium loads in a whole life policy. But we basically run whole life illustrations through the Veralytic system twice, once backwards and then forwards, where you can get the cost pages on a whole life product if you're a Veralytic subscriber.
Okay, great. This is a great question from Reg, Barry, and that is, how do you feel about using whole life cash values to fund retirement income, surrendering basis, then taking loans? The illustrations look nice, but administering the plan once the client has retired seems difficult to do with the carriers. Once the client reaches, say, their late 60s or early 70s, the ability to exchange to a better policy may be limited from a health perspective, as you know. Does Veralytics have the ability to help evaluate these options for clients who have been paying into whole life for many years?
So yes and no. So yes, Veralytic can quantify the things that will determine long-term performance. So it will quantify, are the expenses low relative to peer group? Is the actual historical performance superior or inferior to peer group? Is it consistent with expectations? Veralytic can help with all of those elements of the decision. But who asked that question?
That was Reg.
Reg points out a number of interesting considerations that are, at least I don't know a mathematical way to ascertain them, like administrative capacities. These policies, the policies have to be administered in a very specific way. Withdrawals to basis first, then loans thereafter. If it's an IUL, they argue that you should do loans first. But either way, implicit in that illustration is administering it in the way that it's illustrated. And unless the administrative infrastructure is there, then that's a really, really good question. Really good planner or market reality question. This illustration looks good, but is this something that's really going to come true for my client? Veralytic can help ascertain whether the costs are reasonable and the performance is reasonable, underlying those expectations. But administration is a big one. Tax laws are another one. I don't think there's a lot of risk that the tax laws would change adversely to Reg's comments, but they could. So I think I don't have any opposition to that strategy. I don't have any opposition to any strategy that a client understands what the risks of it not happening are and the benefits of it happening. We're just a proponent that whatever the strategy is, don't let the tax tail wag the economic dog. Make sure that, as CFP practice standards now say, make sure that the product recommendation underlying that strategy is in the client's best interest, that costs are justifiable, that performance is reasonable to expect, and that risk is appropriate.
Yeah, absolutely. Yep. Gordon, good to see you on. Andrew, good to see you on. Yes, today's session is being recorded. We will post it on the members-only portion of the site by end of tomorrow, so no worries there. Gordon, I hope I get this question right for you, Barry. How to adjust perhaps for lifetime products that include chronic illness at no cost? And I don't know if that was a question or more of a suggestion for a topic that we should address. Case study, I think that might be a suggestion. Okay, Gordon, I know you've mentioned that to me before. Does that make sense to you, Barry?
Yeah, I can comment that the Veralytic report that the different long-term care riders or critical illness riders vary pretty widely in benefits, and thus don't lend themselves to benchmarking, because if you really can't benchmark an apple versus an orange. The Veralytic system, if one policy includes long-term care or critical illness without cost, and another one includes it but charges something extra for it, the Veralytic report will reveal which policy in total offers the lowest costs. So it's useful in a holistic sense, but not specifically as it relates to the long-term care or critical illness rider.
Okay, great. One last question, again from Michael, and this is, I think, brings us to the end. Universal life would produce a greater income, all things being equal, question mark.
The product type that has the lowest costs will generate, if everything else is the same, the product type with the lowest costs will generate the highest income. Sometimes that can be universal life. Sometimes that can be whole life, depending upon the risk profile of the client. If they're more aggressive, then the income would be greater out of a variable product, or I shouldn't say will be. It would be reasonable to expect, with a long enough holding period, that the income out of a variable product with a more aggressive asset allocation and thus a higher rate of return would be greater than a universal life product or a whole life product. But Morningstar publishes a study every year saying that costs are the greatest determinant to long-term performance for a given risk profile. Costs are the greatest determinant of long-term performance. So the product with the lowest cost, whichever type it is going to be the one to generate the best income or the best accumulations in best income.
Sure. Well, I think that brings us to the close with questions at 12:43. I suspected and not surprised we got as many questions as we did. And really, Barry, thanks so much for staying over, and thanks for the great information. Certainly excited to think about having you back for case studies and the other sessions that I know we will put together. So on behalf of everybody, heartfelt thanks for spending so much time and all that you've done for the industry. You certainly have been a pioneer and much appreciated. So thank you.
You are more than welcome. This was great fun. I mean, you got a good group here, Tom. I'm a little more than a little flattered that 42 people would hang out this long to talk about life insurance. Appreciate all the questions. Appreciate you. Appreciate your group. Happy to come back.
Great. Wonderful. Thanks, everyone, for joining. Again, we'll put the replay up on the site by end of tomorrow, along with we will get the Kitsitz article from Barry, and then I will likely in the next week or so get a semi-raw transcript posted as well. And as always, I hope you come back for tomorrow with Larry Swedroe and take advantage of all the webinars that we have each and every month. So best wishes for a great rest of the week. And Barry, take care and talk with you soon.
You too. Bye-bye now.
Thank you very much.